Good afternoon and happy Madaraka Day, everyone. So my name is Mnyindo Tairo, and I'm the founder of La Risk Africa. At La Risk Africa, we are very passionate and extremely good at now the protection and preservation of wealth. A little bit about my background. I have a background in mathematics, but the one thing it is that I was being passionate about is now wealth management. And I specialized in the protection and preservation of wealth because we realized that a lot of families focus on growing and creating the wealth. They accumulate all these assets. And because of lack of proper planning, all these assets end up disappearing over a period of time, and sometimes even during their own lifetime. So we've been asking ourselves this question: how is it that we can do things differently at all stages in life? So I also have a background in mergers and acquisitions. I used to work with a lot of very successful families, and I've been able to see how it is that they've been able to, the ones who were able to preserve wealth and the ones who are not able to, what it is that they did well and what they did not. And these are the things that I've learned over about a decade, and these are the tools that it is that I'm going to share with you. So for today, we're going to start with the fundamentals, because at the end of the day, the principles remain the same. But now we're going to start with the way it is that someone can actually just start right now, where it is that they're at, and then eventually build up within a period of time. So I'm really looking forward to taking you through this session. Thank you. Okay, Susan, please allow me to share.
Mnyindo, are you now able to share your screen?
Let me try. It says that you disable the screen sharing.
Just a minute.
Okay. So maybe even in the time being, you could be letting us know what it is that you're expecting, especially in my session. We will be taking you through in how it is that you can protect this said wealth, the importance of doing that, and how exactly to go about it, creating structures and systems around your wealth. And I would ask you to just take yourself very seriously and take your wealth very seriously, because you have to remember that as we're building this wealth, there's people who are very dependent on us. We are dependent on ourselves and the ones who are dependent on us. So if we build this wealth with weak structures and very faulty foundation, that means that eventually when this financial house falls down, it's going to affect even the people it is who we are growing with. So it's very important now to make sure that you are able to take charge of this specific season of your life. So
you can try now.
Okay, now it's fine. Thank you everyone for your patience. So let's just get started, because I know. So today's conversation is going to be on, obviously, the family wealth, protection and preservation of wealth, which is something it is that, as I mentioned, that we are very passionate about, and one thing that we really, really need to ensure that you learn, not just for you, but even for the generations after you, but also for the ones before you, because there's things that it is that we can actually teach the people before us, like our parents, even our siblings, our aunties, our uncles. Because remember, when it comes to matters wealth, it is a family thing, right? And so I've already introduced myself. So let's get started. So this webinar is for you. Number one, if you are a parent, a grandparent, a guardian who obviously wants the best for their children, or anybody who it is that you identify as a child and the generation after you, if you want to set up your kids for success right now or even in the future, even if you do not have children now, but you're planning to at any time, it is important to now really listen closely in this conversation. If you also want a very comfortable retirement for yourself and for your parents, and you want a simple, streamlined solution to ensure that you and your family are set up for success, Yeah. And you also want to take charge of wealth and how it is that it is distributed. So at the beginning of everything, before you even start creating, looking for the tools and coming up with a blueprint, it is very important to know, what exactly does success look like in my family? How exactly do I define it? Because it's always important to start with the end in mind, because at the end of the day, we are very different. Even no two families are the same. So how it is that we measure success is very different. So you have to ask yourself, okay, does it look like a happy and healthy family? Your children are happy. You love to travel, retirement in your own terms. It's very important to start with the end in mind, so that every single time you're doing this, you know that you're doing this because of this reason, right? And I know a lot of people, especially when it comes to matters inheritance and family wealth, we love to cite Proverbs 13 verse 22, the one that says, a good man leaves an inheritance for his children's children, which I love. But there's this one which I came across, and I even love it equally as much, because it actually is going to speak a lot on what it is that we're going to talk about today. It says, I will not burden you financially, because I do not want what is yours. Not your money or your possessions, but you. Yeah. For children are not responsible to save up for their parents, but parents are responsible for their children. Because what it is that we have seen, especially in our context, in our African setup, a lot of people get burdened because they find. Hello?
We
Okay.
can hear you now.
Okay, thank you. Where did you lose me?
You are just muted for like a few seconds,
Okay.
so you can pick it up from the Bible verse.
Okay, thank you. So as I'd mentioned, that with this Bible verse, to me, it really resonates with everything it is that we're going to talk about today. Because when it comes to the African context, what has been happening is we as the children end up taking care of our parents, when even here in scripture, it says, if you do believe in scripture, but I believe this is pretty universal, that we as parents are the ones who are meant to set our children up for success, because we're the ones who have come in before them. This is why we are having such conversations, so that we know how is it that we can build capacity ourselves as parents and be able to build this world, so that now we ensure that we are a stepping stone and not a stumbling block. So please put this in mind. You are meant to save up for your children, not the other way around, right? So this is something I'd want you to ask yourself. This is it's going to be very introspective, right? So you're going to answer it within your own heart. Yeah. Are you interested in making any of these decisions? Number one, who exactly receives my assets? So you have to decide, is it going to be the courts that decide, or you're going to have a say? Yeah, because the one thing you have to remember, there's already rules and regulations around how your assets are going to be handled. Now it's up to you to decide how exactly it's going to go about. And if you do not decide, someone else will decide it for you. And in this case, it's the courts of Kenya, right? Number two, when will the heirs receive my assets? Will the courts decide, or will you take charge and you have a say? Yeah. Number three, who are going to be the guardians of my kids? Is it the courts that decide, or you're going to have a say? Yeah, that is the third question. Number four, in the case of medical and financial decisions, if you are incapacitated, who is going to make these decisions for me? Will you let the courts decide, or will you have a say? So the reason why I have to ask these questions is because we work a lot with clients or people who we are seeing going through these situations. And the reason why they're in the tough spot they're in is because they did not make a choice. So we want you to now be able to take that control. And the fifth one, how exactly do you want your retirement lifestyle to be? Do you want well-wishers to decide, or your children to decide how that is going to look like, or you're going to have a say? So the webinar goal for you is to take you from a place of disorganization, a place of anxiety and stress, a place where you could easily get disrupted because you don't have proper structures, a level of disempowerment, to a place where now you feel organized, you feel like you have a peace of mind, and there's minimal to no disruptions, and you are feeling empowered. Because there's one thing we need to face in life: the fact that we do not live in utopia, we do not live in a life of perfection. So we need to remember that life does happen. And how is it that we plan ourselves is going to determine what will happen at that time. If you have a good plan, it means that the mountain that could have been created that time will be turned into a molehill. But if you do not plan, that means that then it can go from 0 to 100 real quick, and it can end up being a huge disaster. So what we want you to do is to take your power back. To take your power back from the government, because if you don't plan, the courts will decide to you. We want you to take your power back from relatives. There's some things which only you know the best. And if you don't do that, you will let everybody and anybody around you to make that decision for you. And sometimes even strangers, creditors, we don't even know who it is that actually are eyeing your wealth. Yeah. If you do not make a plan or take a plan, it means that they will plan for you. And the people who will be left in a vulnerable position is who? Your kids. So what exactly will this webinar do for your children? It will ensure, based with the plans it is that we're going to help you put up in place, it will ensure minimal to no interruption in your children's lives. Yeah, because when it comes to trauma, it's because there's been so much interruption and so much of lack of planning on our end that ends up going to them, which ends up now moving forward. That is how generational cycles of now poverty continue, because if one person did not break it, it means it will have to manifest itself in the next generation. Number two, give our kids a head start in life. As we said, we want to be a stepping stone and not a stumbling block. We want a position where our children will be so grateful that we actually existed and we were their parents because of the plans it is that we put in place. We had them in mind in everything it is we did. We need to protect their dreams and visions, because if we do not put plans in place, it means they will not be able maybe to do what it is that they wanted to do in their hearts. And lastly, financial stability for the children. So we have to be able to now talk about which are the different types of families who we want to listen in. So first of all, we have the traditional families. So traditional families are the ones we commonly see, the father married to a mother and they have their children. So with traditional families can also look very different in the case that there's some who have stay-at-home spouses or the wife could be a housewife or a house husband, or now both, it's a two-income household. So even traditional families do not look the same. And secondly, we have modern families. So modern families, we have to remember that families have changed over a period of time compared to what it is that we knew. And now there's new ways that family look like. And we have to make sure that we also accommodate them in our planning, because if there's people who are extremely vulnerable are the modern families, especially if there's no lack of planning. Yeah. So number one, we have single parent families. That means that there's one parent and taking care of the children. Maybe they're single parents because of divorce or widowed, or maybe did not work out with their significant other. Then we have divorced and widowed who are remarried. So this means blended families. So you see, there's people who are in blended families who are never married before, and there's people who are in blended families who are married before. We have domestic partnership. This means that people do not have they don't have a marriage certificate. Yeah. We have multi-generational families sharing a home. This means that you're living with your mother and living with your child. So there's 3 different generations in that home, right? And then we have families with parents having kids later in life. So usually before, people used to have children, say, in their 20s, early 30s, but now we're having more and more situations where people are even having kids in their 40s. And you see the dynamics change, because if you have your child, say, like at the age of 42, we have to be able to put them into consideration, especially when it comes to retirement, because most of the time when we've retired, if like it was now children were born when the parents were young, it means that the children are now able to fend for themselves, right? And then we have child-free families, right? Couples who choose not to have children. So the question is, what exactly could disrupt your child's life today? What could make everything that was going okay just completely fall apart, right? We have to first of all look at the cycle of life. So from the time it is that you are born, to the time we get into our 20s, our 40s, our 60s, until the time it is that we die. We have to remember there's the two dates, the date of birth and the day we are going to pass away. And what is in between is what we call life, right? And now let's look at now this cycle of life from the eyes of a child. Yeah, what exactly it is that could actually disrupt? Because remember, at that time, at the top part of this circle, that means that there's actual no income. Those are the times when you're extremely vulnerable. So first of all, now we're going to start with the fact that now you are a child. You're between maybe the age of 0 to 20 or early 20s when you're still highly dependent on your parents, whether it's for school fees, for necessities. And in the case anything was to happen to your parent or guardian at this time, it means that everything will fall apart, right? Especially if there was no plan. So number one, what would happen if my parent or my guardian lost their job? Yeah. Number two, died. Because remember, they are providing an income. If they die with their income. It doesn't mean that I still do not need a house or to get educated. Number three, what if they get an accident or get disability or got a critical illness like a cancer, a stroke? You know, what if, yeah, they did not plan for my education, right? What if they did not plan for their own retirement? And what happens if they did not secure an estate plan? At this part, I would like to challenge you to look at it now, maybe in your own life and the people who it is that have come before you, whether it's your parents, a guardian, your grandparents. Has any of these things actually happened, and how did it exactly affect your life? Because what it is that we're trying to do is to see how maybe their decisions disrupted our lives and how it is that we can move forward differently so that we make decisions that do not disrupt the lives of the generation to come. So first, let's start. What are the 5 consequences of the death or incapacitation of a parent without a plan? Because a lot of the questions were falling around if a parent was to pass away or to get extremely sick or get a disability. So first of all, based on experience, because we see these things a lot, especially now when you are in the family courts. When parents pass away, when the guardians pass away or get a disability, what happens, especially if it's a home of multiple children, the children are split and bounced from one house to another because they're considered a burden, right? The one thing people have to remember is usually after the funeral or after people have been able to help you, it reaches a point they can no longer help your family anymore because they have their own families, they have their own lives to live. Your children are no longer their priority. Yeah. Secondly, there is the downgrade of lifestyle. So you can imagine someone used to go to a very good private school because that is what the parents could afford. But now when they pass away and there's no plan on how this school fee is still going to be funded, who's going to take care of them, obviously they'll have to change schools. So it will really be very traumatizing for the child and even the home. They used to live in a certain neighborhood, and because of lack of funding, they have to shift, right? Then this trauma of the death, the actual death or incapacitation of the parent, and the children could actually be taken care of, taken advantage of, whether it's by their relatives or even sometimes strangers, because people know that they're in a place of vulnerability, so they can come and take advantage of this child. And there's also now the long court processes. What is it now that we can do to ensure that this does not happen to any of our children? Yeah, because we love our children so much. This is not their portion. This is where now the unfair advantage package comes in, and we're going to talk more about it. So what does unfair advantage mean, especially in this context? This means that we're giving our children a competitive advantage in life. We have seen situations where there's 2 children who could maybe have the exact same, for example, maybe a bit of a background, or they have the same capabilities, but because of the different ways that they were raised, then one has an advantage over the other. They have a competitive advantage over the other, whether it's now in terms of their families have taken care of their wealth, their education, all these amazing opportunities. So how I like to look at it, I tell people, look at it this way. If you're going all the way to the 30th floor, there's the child who is on the 2nd floor, and there's the one who's on the 28th floor. Who will reach the top first, right? The person who's on the 28th floor, definitely. So obviously the person on the 28th floor has an unfair advantage compared to this one, even if they have the same capability, even if they're still very smart in school, but one will have more of a stepping stone compared to the other. So our goal here is to ensure that our kids' lives are not interrupted, no matter what. Even if a parent dies, gets an illness or a disability, our children's lives, at least financially, will be able to continue. Number two, to ensure that the child's life is not interrupted when older and retired, because it's very clear, and we have seen it a lot, because a lot of the generation before us did not plan for their retirement. They are highly dependent on their children. So the children are not even able to actually take care of their own finances, because you're taking care of your kids and you're taking care of your parents. And I've met a lot of people who even choose not to have children because of the burdens that they have from their family. So they cannot even live the life of their dreams. Number three, to ensure that the assets are distributed according to your wishes. So yes, you could plan, create all that money, collect all these assets, but how exactly will it be distributed from one generation to another? Yeah, and will it be distributed according to the way you want it? And number four, give our children a competitive advantage by giving them a head start in life. Right? Whether it's now having an entrepreneurship or business fund, an education fund, house down payment, ask yourself, like right now, like I usually say, like if someone was to drop for me 5 million shillings today, I don't even know. I have a feeling that I would be very, very firm, especially now when it comes to my business, because sometimes what it is that you need is just capital to do some things here and there. But because you don't have the capital, you have to work now harder to be able to get that. But you see, the thing is that if someone already has the mindset and the values, if they had the money, it means that they will be able to expand it. So you ask yourself right now, if someone was to give you a 5 million, you find out your grandparent left you that cash, how will it help you right now, right? So even before we move forward, we need to understand there's two types of assets. So there's what we call probate assets and the ones we call non-probate assets. And then I'll tell you what it is that we'll focus on in my session. So probate assets are the ones that go through court process in order to be distributed to your dependents or beneficiaries. So it means that when in the case you die or in the case you're to get incapacitated, this matter has to go in court because there was no plan in place. And then non-probate assets, these are assets that are passed out of court through means of beneficiary designations. So what, like examples of probate assets are like, real estate. If you have land, you have houses, business, personal, any sort of personal property, whether it's your jewelry, vehicles, those are probate assets. Those ones cannot just be automatically be given to your children in the case you're to pass away or get incapacitated. But now for the non-probate assets, like now the life insurance policies, retirement, pension plans, and investments held in a trust, which Winnie is going to talk more about, these ones do not have to go through probate, right? Because as long as you've designated this is the beneficiary I want, it will automatically go to that beneficiary. It surpasses it, it does not go through court. So when it comes to now the unfair advantage, from my part, what it is we're going to focus on is the non-probate assets. Yeah. When it comes to the planning, Winnie will focus on how it is that now we can structure now the probate assets in a way that it can be put now, it can now go through to the beneficiaries without having to go through court. So today, now at this session, we're going to focus on the non-probate assets. So what exactly is the unfair advantage? So we need to make sure, number one, remember we said we do not want interruptions in our children. The protection against premature death, the critical illness or disability, and also protection against outliving your income and distribution of wealth. So all these three in one is going to make up this package, right? Because all of them have a role to play. We cannot just take care of, protection against premature death. What if now you live long, right? What is going to happen at that time? Or if you just take care of your retirement and you don't take care of, in the case something was to happen to you when your children are still young, what happens? And then also additionally, we need to figure out how exactly this is going to be distributed from one family to another, right? So now we're going to start with what we call a whole life cover. We're going to go quickly through it, and so that now you can understand how exactly it plays a role when it comes to planning your estate. So what exactly is a whole life insurance? So, and how does it play a role in the transfer of, your wealth from one generation to another? So it provides protection for life. That means that it will definitely pay out because death is a certainty. It's an eventuality. Everybody's going to pass away one day. So it's something that is going to definitely be paid out. It offers a death benefit to beneficiaries when the policyholder passes away, and it has living benefits. So in the case of a critical illness or accidental disability, and also it does not go through probate courts. So what are the uses of the life insurance? So it's very good for protection planning in the short term and inheritance planning in the long term. I will show you right now on how exactly that works. It's very good at what we call estate equalization. I'll also go through that, and wealth transfer. So let's just go one by one. So protection planning. So we have to remember this is now your child's life from the age of 0 till whenever it is that they're going to live for. The time our children are most vulnerable, the time they're fully dependent on us, the time if something was to happen to us, they're going to be affected, is usually between the age of 0 to 20, 25, around there, until the time it is that they leave university. Just think about it. I don't know if you've ever seen someone who's gone through it yourself, that something really terrible or something hectic really happened to your parent during that period, and it affected you drastically because you are fully 100% dependent on your parent. This is how, if parents have not put plans in place, this is how children end up growing even beyond their ages, because they have to take this role at that point, because there's nobody who's going to take care of them. So between the age of 0 to 25, this is where now you really, really need to ensure that your children's protection is taken care of. So if a death, disability, or critical illness happens in this zone, that is not even, I don't even know if you can call that an inheritance. That is mostly protection, because what is happening there is that it is going to replace your income, right? That is what it's meant to do, because at that time, the children don't have the capability to go out there and make money. Yeah, at this time, it means they're fully dependent on you. So if anything was to happen here, it means that they're going to be really thrown away, right? And then if something happens to you, say after the children have hit the age of 25, if everything has gone according to plan and they have our job, most probably they will not be as affected compared to children who are between the age of 0 to 25. So you have to look at it right now. Where exactly do your children fall? How old are your kids? And if your children are not born yet, now they'll have to fall in this side of the protection, because they will be born at some point. So when it comes to a whole life protection, you see, because it covers the rest of your life, between the age of 0 and 25, it's mostly protection, yeah? Because this is mostly for replacement of your income. Anything past 25, any money that comes there is just going to be now an extra to help now with the planning of your estate, and it can come in as an inheritance, as a cash inheritance. So please always remember that, right? Number 2, so we had mentioned that there's living benefits, which had said critical illness, which pays out a lump sum in the case of a diagnosis. So sometimes you might not die, but you might get really, really sick and you can no longer work. You can no longer provide that income. This is where now the living benefits of this life cover kicks in, and it pays a lump sum. So you do not have to affect or really drastically change the children's life, because this amount of money is going to continue paying the bills, and it will now replace your income, right? When you can no longer work. Same thing with disability cover. In the case you're going to get a disability due to an accident or an illness, it will pay out a lump sum. So secondly, so remember the first part was for protection, planning, and inheritance planning. Number 2, there is what we call estate equalization. So let's look at Victor. Victor has property, a piece of land that is worth 5 million shillings and a house that's 10 million shillings. So if he wants to bequeath his 2 children, Mary and Tom, how is he going to do it? If he was to give Mary just the land for 5 million shilling and Tom the 10 million shilling house, that means there's going to be a bit of an issue when it comes to them as siblings. One might feel that the parent favored one over the other. So what can someone actually do in this situation to make sure that everybody gets equal amount of inheritance, both Mary and both Tom, right? So this is where now a whole life insurance can come in. In the case now, there is the 2 assets which do not have equal value. So Victor can actually buy a life cover worth 5 million shillings, which is going to put Mary as a beneficiary. Please note that down, especially a lot of us who have lots and lots of assets, lots and lots of land. Sometimes to be able to divide it equally might be hard. So it's easy to say, okay, this child can get this piece of land, and then this one can get this land. But because of the value of this land, it's not as much as this one, you're going to supplement it with a life insurance cover, because this is what the children are going to get when you are no longer there, right? So you can see here, it's now going to be equal, 10 million. So Mary will get the land of 5 million shillings plus the life cover benefit of the 5 million shillings to make it 10 million shillings, to let it be equal to what Tom is going to receive, 10 million shillings, right? So another way of looking at estate equalization is, especially for people, it is in business and family businesses, right? So maybe now you have 2 children. One child, from here we can see the one who's interested in the business is the daughter, right? And we have the son who decided to go now do medicine. So most probably he's not actively interested in the business. So how exactly can you make sure that everybody gets an equal stake, especially in when it comes to your overall estate? So what can happen? This man can buy, the business owner can buy life insurance of the value of the business. So the business has to be valued. Say the value of the business is, 100 million shillings. So this means that this business owner can buy an equivalent of that inner life cover to ensure that when the time he passes away, there's going to be minimal fights or no fights at all, because everybody has gotten equal share in the assets. So the daughter will continue running the business, running the company, because she's the one who's been showing interest in the company and she's good at it. And the son will now will get the cash to do something else. Maybe he'll now open his own, clinic or a hospital. You see, now also when it comes to family business, it's important to put all those factors into consideration, because as I said, I used to work in a mergers and acquisition. This is where a lot of the fights came in, because usually there was lack of communication and parents never really sat down and put this into consideration. So you can imagine, I have 2 children, one who has never ever been interested in the business. Then all of a sudden, if I was not there, this one now says they want to take part of this business and they were never there. Yeah. So it will be good for you to know beforehand, to be able to predict what could possibly happen and plan for it. This is how visionaries work. We have to look at things long term and nip it in the bud, right? And then thirdly, we have it as a wealth transfer tool. This means that we're moving these funds from one generation to the other. Actually, this is the easiest way to transfer wealth from one generation to another. You do not need like a lot of time to be able to create, an estate, buy property or buy houses, because, like building wealth takes a lot of time. But if we want to ensure that no matter what happens at whichever stage in life, because remember, where we're at now is what we call the wealth accumulation stage. If something happens to me in year 5 and I have very young children, that means I will not have been able to accumulate the level of wealth I would have expected if I was to maybe live till the age of 50. So what I could actually do right now is to get a life cover. So in the case this was to happen, yeah, because life happens, nobody ever knows when it is that they're going to go. It means that my family will have an instant estate from the life cover. So number one, life cover is a tax-efficient wealth transfer strategy because the proceeds are not taxed. So the money that is written there as the sum assured is what exactly the family is going to receive. Yeah. Number 2, it does not go through probate courts. It goes directly to the beneficiaries. Number 3, it's a simple way to create an instant inheritance, and it's best used together with a trust, which we're going to look at further later. And how much cover is actually enough? So rule of thumb is usually 10 times your annual income. And I've put an example here. If I earn 100,000 a month and my annual income is, 1.2 million, for 10 times of 1.2 million is about 12 million. This should be able at least to take care of my kids or my family for a period of time to replace my income. Yeah. So I want to pose this question to you. I want you to calculate what is your current life insurance needs? What are the life insurance needs for your family? Because you have to look at it this way, because it's important just to look at things positively, but it's also important to know that anything could happen at any time. So for you to be a prudent and to be a wise planner, it's important to also take care of the risk management aspect of wealth management. So what exactly is your monthly salary right now? And for you to get your annual salary, multiply it by 12. And then eventually for the life insurance need, whatever it is that you got as your annual salary, you multiply it by 10. Usually the rule of thumb, it's usually 10 to 15 years. And it changes in the case now, maybe someone has a loan. If you have a very big loan, most probably your life cover needs might be higher. But this is one of the places it is that we can be able to help you. In the case now you need further guidance. And then the current sum assured, because I know some of you maybe have already existing policies, whether it's education, endowment policies. What is the sum assured of that policy? So that now you know that this is the amount of coverage it is that I need to get. Yeah. And the beauty about the life cover is that you can start it with what it is that you have. So this one is just for you to have the end in mind. How much is it that is actually needed? But you can always start with whatever it is that you have. So I wanted to show you some examples of the whole life contributions and the payouts. So this is a 30-year-old, let's call her Mary. She wanted a life benefit of 10 million shillings and critical illness of 5 million and accidental of 5 million. That means that this is an amount of money that will be paid out cash in the case any of these events was to happen. So the term of contribution of this cover is 20 years. So what this means is this person will contribute for 20 years. In the case she was to pass away before the 20 years are over, the family will still receive a payout. Let's say now it's 20 years and nothing has happened to her, because actually chances of actually outliving this is high. When the 20th year is reached, you stop paying the premiums, but the life cover is ongoing for life. That's the beauty about this. Yeah, and she's a non-smoker. So the premium per month is going to come to 6,698, right, for her to get a 10 million shilling cover. That means if she had children and she was to contribute this religiously every month, and say she dies in year 2, the family will have to get 10 million shillings. Remember, this is not an investment, right? Because if she was to contribute this 6,000 for the next 2 years, it will barely be even like 200,000, right? So this is where insurance comes in to create the instant estate. So let's look at the gentleman at below. He's 40. So then now you can see the difference in terms of how age actually affects the premium amount. So you can see it's still the same cover of 10 million and 5 million accidental and disability, still term of 20 years, but he has to pay 9,968 as a non-smoker, right? A whole 3,000 difference because of age, right? And if he was a smoker, because smoking actually does affect your premium rates, he'll be charged 12,592. So you have to remember, this is an amount of money they put aside every month, which will create an instant estate in the case of a death, disability, or critical illness. And this one, the person who's 50, you can see for the exact same 10 million, right? She's paying 18,000, almost triple what the 30-year-old is going to be contributing. So you have to always put this into consideration. And the last age you can actually get a life cover is 60 years. And the one thing people need to think about is, sometimes people are like, oh no, I don't have kids right now. I do not have a need right now. But sometimes situations changes, right? But maybe the time the situation is changing, you are not insurable, because it's not even 100% for sure you're going to be, the insurance company can accept you, right? The older you get, sometimes the chances are higher that you might, if you have some illnesses, the insurer might either now completely increase the premium, or they might have to completely deny you coverage, right? So let's look at a few definitions, which I think people usually find confusing. So number one is next of kin. So next of kin is the closest relation who can be contacted in the case now someone gets an illness, an accident. I'm sure, like, maybe if you start working in your offices, or sometimes even if when you go to the hotel or to the hospital, they ask you to write down your next of kin. So in the case of anything, this is the person who will be contacted. So most people confuse this with beneficiary. Beneficiary is the person who will actually benefit from the financial product, yeah, or whatever it is that you've put in the trust, right? This is the person who is going to be benefit from these things. So it's different from next of kin. Next of kin will be notified, and beneficiary is the one who's going to receive the proceeds. So sometimes, yes, a next of kin could be a beneficiary, but it's not necessary that a next of kin is a beneficiary. And guardian is the person with the legal responsibility of taking care of someone who cannot take care of themselves. So this now is usually children, because when the children are under the age of 18, they cannot be given the money. It has to go to the guardian, right? And sometimes it can be children over the age of 18, especially if maybe they have their special needs. There's people who need a guardian even after they hit the age of 18 because of specific situations, yeah? So appointing a guardian. So remember, a child cannot access funds if they're below the age of 18. So the guardian acts as a beneficiary of the claims proceeds when the child is a minor. So let's give an example of Mary before. She has taken a cover of 10 million shillings, and she is a single mother, right? And she put her friend as a guardian, or her sister as a guardian. So that means in the case she was to pass away today, the person who will receive the money cash into the account is this guardian, because it's the person it is that you've actually listed to receive the money on behalf of your child as long as the child is not 18. And secondly, guardian receives financial benefits of the insurance policy, as I've mentioned, upon death or maturity, if it's an education or endowment policy. If the child was to pass away, the guardian becomes the final beneficiary of this insurance process. Because remember, this money is in the account. So this is where now maybe their family might benefit from it, because you are the one who put down, this is the guardian, and this is where the money is going to go to, right? So another question I'd like you to ask yourself is, are your life cover documents in order? So are your documents safe and accessible to dependents or to people it is that you trust? Because a lot of these policies sometimes end up in unclaimed assets because nobody even knows that they existed. So it is important to put these things in order, and at least for someone to know that it exists, right? And then have you nominated beneficiaries for each cover? Because sometimes we see people filling in the forms and they leave the beneficiary part blank. Even if the beneficiary part blank, what it means is that the life insurance proceeds is going to be part of the estate that is going to go through probate, which does not make any sense. So rather just write down who the beneficiary is going to be. Are your beneficiary details up to date and relevant? So we usually see in the cases, say someone was single, then they ended up getting married, and they forget to maybe update it from their mothers or their parents to their spouse and children. And now when someone passes away who was in this situation, there's a lot of back and forth, because remember, this cannot be taken to court. So it will be paid out to the mother, and it's at the mother's discretion whether this money will reach the children, right? And again, are the supporting documents up to date? Another very important thing, you have to make sure that the names that you have written down in the life policy is matching the actual names in the ID, right? Or the birth certificate. Do not even miss a letter. Do everything it is that you can to make sure that this is correct, even if you have to ask now for the actual copy of the ID to make sure that everything is okay, especially now for the guardians and the beneficiaries. And then it's important to confirm your policy status with your insurer or even your employer. You know, like if it's your own policy, are you in arrears? Is your policy up to date? Because some people are walking around thinking that they're covered, yet they are not. So it's important to know, as of now, where am I? So that's why it's important to always have, say, a money date every month, or you can tell yourself we'll be checking this every quarter to make sure that everything is in order. But for life cover, I would say once every year, unless maybe there's things that have changed, like a marriage, you've gotten divorced, you've gotten a new child. Otherwise, do it every year. So uptake of life cover, what exactly happens when it comes to, if you want to take up life cover? So when it comes to taking up life cover, from now our end, you'll have to fill in a form, which will be shared, the life insurance form. You fill it in with your details so that now we can be able to match you with the best product or the best solution for you. And this is how usually a typical quote looks like, so that now you can know the details, especially now what is covered and what's not covered, right? And the application process, so you need to complete the proposal form, pay the first premium. Yeah, you need to provide the documents now, like the ID, carry pin, proof of banking. You get the medical examination if necessary. Usually for some insurers, you can get it without medicals until a certain limit. Beyond that limit, you actually have to go to do your medicals. Yeah, the insurance will then review the proposal form and documents and issue the policy document. Yeah. So the proposal can either be accepted without any changes, rejected, or accepted with a loading. So usually accepted with a loading is, say, for example, someone has been found they have cholesterol, high blood sugar, but sometimes you can actually negotiate with the insurer. Some insurers accept this. You negotiate that within a year, maybe for things like BMI, you can work on it and change so that now your premium can be brought back to the normal amount, right? So making a claim is also a very important aspect, especially when it comes to getting now a life cover. It's important to, first of all, notify the insurance company, whether through your agent or directly yourself. You fill in the necessary claim form. Then you give the documents required to process the claim, which is usually the death certificate, the beneficiary guardian or guardian ID copy, and the bank details where this money is meant to be deposited. And the claims process usually takes about 10 to 14 days after you have after you've put in all the right information. Because actually the place where there's an issue with claims is when, number one, the documents are not in order. Number two, if someone actually lied in the application, say you are a smoker and you lied that you are a non-smoker and you die from lung cancer, the insurer will be like, you lied. The whole basis of this application was a lie. So it will be at the discretion what it is that they'll do at that point. But in the case now you're to take up cover, I would advise you to say the whole truth and nothing but the truth, because it will usually catch up with you, right? So I have finished that first part. I don't know if there's any questions so far, Susan.
Yes, we have quite a number of questions.
Yes.
Number one, I'm really, really enjoying this so far.
Yes.
It's really, really good. So the first question I have on my end in the Q&A session is Sibongile is asking, what happens when one can no longer pay the premiums? I've also seen someone else in the question in the comment section ask, what if they got, like, for example, life insurance that is 20 years long, and then in year 15, for one reason or the other, they are not able to pay the premiums. So maybe we can start by answering that one.
I love that question. That's a very good question, especially when it comes to now payment of premiums. Because of the long-term nature of the life cover, you cannot just stop paying premiums. So what I would advise, number one, to ensure that you can still maintain this premium is you have an emergency fund. Yeah. Number one is for you to have an emergency fund. So in the case, maybe it was a job loss or for one reason or another, you can no longer pay the premiums. The money that is coming from your emergency fund can be able to still help for some time, at least to take care of the premiums. Number two, please pick a policy that you're comfortable with. And the one thing is, as I said, don't stretch yourself too much, because what I find is people are taking like sometimes a lot of life policies without even any liquidity on the side. So that just ends up being a problem, because when that time comes and let's say you've lost your job, you don't even have anywhere it is that you can cash out. That is why it's important to have a liquidity plan on the side, even as you're having your life insurance. And thirdly, another way a lot of our clients do it is they have an investment that takes care of their life insurance premiums. So for example, you have a SACCO, you contribute money into a SACCO. You can say that, okay, the money that is going to be paid out as dividend every year is going to be taking care of my life insurance premiums. Yeah, that once off a year. Or some people they've bought bonds that are able to pay out this towards the premiums. So you see now, if you're to get an investment, that means that whether you have a job or not, your life insurance premiums are still taken care of. So this is something we also do help our clients with, especially now if they need a bit of guidance, especially in how it is that they can set up now an investment, or we can look into the already existing investment so that we can plan around how exactly it is that they can be able to pay the premiums long term. And again, another thing is, in the case you can no longer pay the premiums, it's something that I don't usually advise, but if now like push has come to shove, you can reduce the amount of money that you're contributing. You can tell the insurer that I want to reduce it to the minimum, or at least to the amount it is that I can afford for now, right? So it's not usually advisable, because obviously when you reduce the premium, the sum assured is going to go lower, and the people who are meant to benefit from this might not benefit. So number one, pick a premium that you're comfortable with. Number two, have an emergency fund, have liquidity plan. In the case you're to lose your income in any way, you can still pay your premiums. Number three, you can set up an investment whose proceeds, or now the interest, can be used to pay for these premiums. And number four, if push comes to shove, you can always reduce, but please also check out to the insurer. Different insurers do these things differently. Yeah. I don't know if there's any other questions.
That.
Yeah.
I love that guys are actually saying in the comment section that using investments to pay your premiums is genius.
Yeah, it is.
Some
Yes, love it.
it is honestly really good. Also someone has asked in the Q&A section, does someone need to a life cover if they do not have children? So maybe we can address like the concept behind that. Like, do you just get it if you have children, or yeah?
So with a life cover, at the end of the day, it depends on why you want to get it, right? What is the need? So you might not, number one, there's different situations. You might not have children now, but you're planning to have in the future. So if that is the situation, yes, you can get it and put someone as beneficiary, say maybe a sibling, a relative, and update it when the child comes, right? Number two, you could be maybe without a child now and not planning to have children in the future, but you have people who are dependent on your income. Say your parents, some people we find like nieces, nephews. So yes, it will be good for you to get a life cover. As long as there's someone who it is who's dependent on your income, it will be important. So say now you are child-free and nobody depends on your income at all. So you could get maybe a bit of cover if maybe you have a spouse who is dependent on your income in case something was to happen. They're going to be drastically affected. You can get one. But you see, the need is lower, right? So most probably if you're getting it, most is for the living benefits, because you see, whether you're going to get a critical illness or not, a disability or not, is not dependent on whether you have kids or not. So sometimes it can be good to take now the cover for the living benefits. And then the proceeds, you can choose to leave it to a charity home. You can leave it for your friends' kids. I mean, you can, it's up to you. Right.
Okay. Someone else also asked, what is actually classified as a critical illness?
Mm-hmm. Okay, so critical illness are usually those major illnesses that most of the time medical covers are not usually enough. So a good examples, let me just go back. I'd listed them here. So you can see these are examples of critical illness, like a cancer, a heart attack, open heart surgery, a stroke, paraplegia, coma, kidney failure, aortic surgery, major organ transplant. These are the ones which can actually create a proper dent in your pocket, right? And you see, when it comes to medical insurance, you have to remember medical insurance has limits. So say, for example, someone got a cancer and the medical insurance, the limit is 1 million. We know 1 million in this economy when you have a cancer might only maybe take you maybe like a month, maybe even less, depending on what stage it is. But you see what the critical illness cover will do, it will pay out now the lump sum to ensure that, number one, you can supplement the money it is that, I mean, like now the expenses it is that you have at the hospital. And secondly, it can actually replace your income. So yeah, these are the critical illnesses, and different insurers cater for sometimes different critical illnesses, but these ones are the most common ones.
All right. So
Yeah.
we have Winnie Mbogo and I think someone else who's asked, they've missed the part. Maybe you can clarify. So someone has paid for this cover for their total 20 years or 15 years, and they've been faithful, right? So the question is, okay, they're still alive, eh? So what happens? I took a cover for 20 years, I've faithfully paid, the 20 years are over. What happens after that, especially if I'm still alive and well?
So for this cover, say for example, like this cover, which we had said that you're paying for 20 years. So you've been paying for 20 years and you're still alive and well. You stop paying for the policy, but it's still going to be ongoing until whenever you pass away, get a critical illness or a disability. So this means that if you paid for all those years and nothing has happened to you, it doesn't mean that now the policy is going anywhere. It will still be there. Or I wanted to understand the question, is it now, if it was maybe they've been contributing for 15 years and they're supposed to contribute for 20?
No, 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 no. It is that you've done it faithfully and
Okay.
you're
No,
done with your 20 years. So what next? I've paid, I've
yeah.
been faithful. What next?
Now what is next is for your dependents to receive it when you're no longer here. So it's one of those things that you have to remember when it comes to a life cover. This is now for, it's not for, maybe for only your peace of mind, but this is now for mostly your dependents, the people who depend on your income or people who you want to leave an inheritance or a legacy on.
Yeah, so I think maybe one thing that we are clarifying with that is that I've even seen someone in the comment section. A life cover is basically meant for your dependents. And I think that
Yeah.
has come out very clearly when you are saying that it is not necessarily an investment. It's a tool that we are using to, kind of like pass down or leave something to the people who depend on us, or people who'd be left vulnerable if
Yes.
at all we are actually no longer there. Our dependents, our children, our parents. Would you recommend, I've seen someone else also ask, would you recommend joint policies? Let's say it's myself and my husband. What are
Okay.
the pros and cons of taking, should everyone take their own separate cover, or should we take joint policies for the children if they're our dependents?
Okay, I love that question. So when it comes to joint policies, so what are joint, for the people who don't know, joint policy means that the cover is on two lives, maybe you and your spouse, yeah, for the benefit of the children or whoever it is that you've chosen as beneficiary. So that means that there's only going to be one payout. It's usually payout on first death. So whoever it is who dies first, the money will go to the person who's remaining. And it's also payout on first first critical illness, yeah, and first disability or death. So the only issue I usually have with joint covers is the level of coverage is not enough, especially in the case one spouse has maybe gotten a cancer, the other one is left exposed. Because the moment you use it, it's going to be, it can no longer now be, I mean, you finished it. You can no longer use it again. If, let's say, for example, your spouse was now to get a critical illness. Okay, you got a heart attack. This one got a cancer. But because you've used this money for the heart attack, the spouse will not be able to use it. So I would advise to take two separate policies so that now everybody can just have their own sort of protection. Yeah, that is how I usually advise. The only time maybe I can advise for someone to take a joint policy is in the case they already have a joint mortgage. Yeah, and now they're like, okay, we need to take a joint policy because we already have the joint mortgage. But otherwise, I would advise to take two separate so that now you can maximize on the benefits.
Okay, Joy is also asking, and I think this is so important in the day and age where sometimes companies come and go. Today company X is in operation, tomorrow it has gone under. So the question is, what happens if anything happens to this firm X or firm Y that I have used for my such a long-term product, like a life insurance, and they go down? What or who protects me as a policy holder?
So the one thing people have to know, even from now, the Insurance Act and just the policy, especially surrounding life insurance, it's very hard for a life insurance company to go down because there's a certain level of amount of money it is that they're not even meant to touch. So in the case now, it was to go down, which is highly unlikely. I don't even know if I've seen one that has actually fallen down. There's still the funds that are kept aside to be able now to take care of these risks in the case they were to happen for the people who've paid until that moment. But the one thing, if there's a financial tool that is very well taken care of and extremely regulated is life insurance, especially life insurance. It's easier for a general life to fall apart compared to a life cover because it's how the policies are even stricter. And secondly, you have to look also at the company itself, just to also to be on the safe side. Look at the history of the company, the reputation of the company, the books of the company, how the company has been paying premiums over a period of time. Like say, for example, this example that I'm showing is for a company that has been there for over 150 years. And the books are extremely good. The chances of it falling is almost zero, right? So those are the things also to look out for when you're picking a company like this. Because you see, as she said, life insurance is very long term. You don't want to put your money for 30 years and then you're told that a company has fallen apart. So yeah.
All right. Now there's something that I also feel is very important, and I think Mnindo at this point, maybe you can spend some time clearly, maybe differentiating. Someone is asking between a life cover and a pension plan, what is the difference? And can you get monthly payouts from a life cover once it matures, or is that a pension plan? So maybe I'm still seeing a need for people to truly understand, like, why would anyone get life cover, and who is the money going to, how are the benefits paid out, and what is the difference between that and a pension plan? And while you're also addressing that, I've seen an additional comment in the chat box where someone is asking, like, what is the point of this thing? Is it worth it? Or rather, is it worth the economic hassle when this person feels that this money will not come through for me as a person when I'm the one who needs help? So she's also saying, he or she is also saying that in the grand scheme of things, if you suffer, then your dependents also suffer. So why is it structured in such a way that you have to wait for it to mature? So maybe you can just address that.
Okay.
Yeah,
Okay.
I feel like it's the goal is, or rather the question here is, there's still people who need to understand exactly who this benefit is, who this money is for, who it's going to benefit, and then clarify the difference between that and the pension.
Okay, so let's start with the difference between pension and life cover. I think the confusion usually comes in because a lot, especially endowment policies, there's people who sell it as a solution for retirement. Because remember, with endowment policies, there's an amount of money that people receive at maturity, at the end of the term, right? But so the one thing you have to remember, let's look at the fundamentals on why life cover was created. Life cover was created to be able to replace your income. in the case of a death, disability, or critical illness. So that means, as I said, if you die or get a critical illness in year 1, in year 5, in year 7, it means that this life cover has to pay out, because everybody comes with an economic value in this life. And when the economic value has been taken away because you're no longer there, anybody who's dependent on you will suffer, right? So what a pension does, so you see, life insurance, especially when looking at it from a protection angle, is to take care of premature death when people are still depending on you, to protect your income when people are still dependent on you. What a pension is meant to do, which we're going to talk about in a bit, is it protects you against outliving your income. So it ensures that you actually receive a monthly income upon retirement, when you retire, at that point of retirement. So remember, life insurance is to take care of death, disability, or critical illness, especially when there's people who depend on your income. It's only now, for example, if, as I said, your children are no longer that dependent on you and you pass away, say later, it will come in as an inheritance. But pension is meant now to take care of you living long, because if you live long and you didn't have a plan around that, it means that you'll have to actually depend on your children. Yeah, so I don't know if I have to answer that question for pension versus life cover. And the other one said, is it worth the economic hassle? Please repeat that, Susan.
She's just saying, is it worth the economic hassle if it cannot benefit me personally when I need the help?
So it can benefit you if you're to get a critical illness or a disability. The one thing people have to remember, why this thing actually is there, a life insurance was created to be able to take care of your dependents, people who depend on you. If you know that today you are to live and never look back, and there's someone who's going to suffer because of that, this is who it is that you need a life cover for. Life cover is not for you. If you want something that is for you, put your money in investments or pension or whatever it is. The only time life cover comes in for you, as you can even see in this table, is in the case you're to get a critical illness or disability. Actually, it will be protecting your investments, because if you're to fall sick, severely sick, or get a disability in this instance, you'll have to liquidate your assets to be able to take care of now your illness or a disability, right? So that is the way maybe a life insurance can come through for you and your own peace of mind. But if you're looking at it at a point of, if you are receiving the money, then that is investments for you. Life insurance, look at it at my kids, my parents, anybody who's dependent on my income. Yeah.
I love that. Thank you so much. We can keep answering the rest of the questions maybe towards the end when we do our Q&A session, but maybe we can continue to the next segment that you had in store for us.